This chart tracks the explosive growth of real-world asset tokenization. In early 2026, the total on-chain value of these assets surged past $65 billion, reflecting a 44% jump in just a few months. Legacy institutions drive this volume, with firms like BlackRock, JP Morgan, and Morgan Stanley leading the deployment of capital into on-chain markets. For decades, traditional capital markets have been bottlenecked by rigid 9-to-5 trading hours and settlement cycles that take 1 or 2 business days to clear. That built-in delay creates severe friction. It forces billions of dollars tied up in private equity, credit, and commercial real estate to sit idle, unable to be deployed or traded efficiently. Moving those legacy assets onto a blockchain eliminates the need for expensive intermediaries. Tokenization converts physical and paper assets into digital representations that can be transferred and settled almost instantaneously. For the major banks, adopting this technology is a necessary structural reconfiguration to unlock trapped liquidity and maximize capital velocity. The initial pipeline for this institutional capital has been tokenized U.S. Treasuries. Government debt alone now accounts for over $12 billion of the on-chain market. Asset managers like BlackRock with its BUIDL fund and Franklin Templeton with Benji are fractionalizing these bonds to deliver highly predictable interest rates directly to on-chain investors. A regulated fund can connect directly to decentralized lending protocols, allowing institutions to earn 24/7 yield without ever selling the asset back into cash. In this ecosystem, Ethereum functions as a real-time clearinghouse, turning static paper assets into dynamic, always-on collateral. The technology has existed for years, but institutional capital remained largely sidelined until 2026, waiting for lawmakers in Washington to resolve the regulatory ambiguity. The first major legislative catalyst was the Genius Act, which established a comprehensive federal framework for payment stablecoins. By mandating that stablecoins maintain 100% reserves, the legislation provided Wall Street with a safe, regulated digital dollar, required for reliable on-chain settlement. That was followed by the Clarity Act, a sweeping piece of legislation aimed at resolving the long-standing jurisdictional war over how digital assets are classified. Under the Clarity Act, strict boundaries are set. Digital assets that function as investment contracts remain firmly under the jurisdiction of the SEC, but the legislation also introduced the mature blockchain test. This mechanism allows a token to shift over to CFTC oversight as a digital commodity, once its underlying network proves to be sufficiently decentralized. This combination of the Genius and Clarity Acts established the comprehensive legal framework Wall Street required to move $65 billion onto digital rails. The analog 9-to-5 banking structure is being replaced by a borderless settlement layer that operates around the clock. We are already seeing legacy banks adapt to this environment. JP Morgan, for example, has moved away from internal ledger experiments and is now using public blockchains as a primary distribution channel for products. By late 2026, Morgan Stanley plans to launch an institutional digital wallet, allowing its clients to execute near real-time, 24/7 trading of tokenized blue-chip equities. This migration of assets into programmable code creates the necessary environment for the integration of AI agents. Because tokenized assets are governed by smart contracts, code that executes automatically, they are compatible with machine-led management. AI agents can monitor yields and rebalance portfolios across different protocols in real time, executing strategies without the delays of human intervention. The $65 billion on-chain today represents the first phase of this migration, building the base for an automated, multi-trillion-dollar global economy. 如果您觉得本期内容对您有启发，欢迎关注视频号华尔街透视，并请您点赞、转发，让更多朋友一起加入讨论。